The New Trading for a Living: Psychology, Discipline, Trading Tools and Systems, Risk Control, Trade Management by Alexander Elder. Hey Power Books fam, ready to level up your trading game? Ever wondered why some traders consistently succeed while others crash and burn? Or how to master the psychological battles that the market throws your way? This time, we're diving deep into Alexander Elder's classic, The New Trading for a Living. This book isn't just about strategies, it's a blueprint for building a resilient trading mindset and a bulletproof system. We'll be breaking down Elder's 3 M's, mind, method, and money, and uncovering the secrets to mastering your emotions, developing a winning system, and managing risk like a pro. Get ready for actionable takeaways that can transform your trading, whether you're a seasoned pro or just starting out. So, if you're ready to trade smarter, not harder, stick around. And if you're new here, don't forget to subscribe to Power Books for more insights into the books that can give you a serious edge in the markets. Part 1, Psychology, the Master or Slave of the Market. Chapter 1, Why Trade? In this introductory chapter, Alexander Elder explores the various motivations that lead individuals to the challenging endeavor of trading. He acknowledges the allure of financial freedom and the potential for high returns as primary drivers for many. However, Elder cautions against unrealistic expectations of quick riches and emphasizes the significant risks involved. He distinguishes between trading as a hobby, a job, and a business, highlighting the varying levels of commitment and seriousness required for each. The chapter stresses the importance of having a clear and realistic understanding of one's personal motivations for trading, as this foundation will significantly impact the approach and the likelihood of long-term success. Elder also touches upon the personal growth and intellectual stimulation that trading can offer to those who approach it with discipline and a commitment to continuous learning. Key takeaways. Many individuals are drawn to trading by the prospect of financial freedom and high returns. Unrealistic expectations of quick wealth are dangerous and often lead to disappointment. Trading can be approached as a hobby, a job, or a business, each requiring different levels of commitment. Having a clear and realistic understanding of one's motivations for trading is crucial for success. Personal growth and intellectual stimulation can be significant benefits for disciplined and learning-oriented traders. Elder warns against viewing trading solely as a path to easy money and emphasizes the inherent risks involved. A solid understanding of why trade forms the essential foundation for developing a sound trading approach. Chapter 2, The Keys to Successful Trading. In this chapter, Alexander Elder lays out what he considers the 3 essential pillars for achieving success in trading. These pillars are mind, method, and money. Mind refers to the psychological discipline and emotional control necessary to navigate the market's pressures. Method encompasses having a sound trading system or strategy for identifying trading opportunities. Money, or more accurately, risk management, involves protecting trading capital and managing position sizes appropriately to survive inevitable losing streaks. Elder emphasizes that neglecting any one of these pillars significantly diminishes the chances of long-term profitability. He argues that while many focus heavily on finding the perfect trading method, psychological discipline and prudent risk management are equally, if not more, critical for sustained success in the challenging world of trading. Key takeaways. Successful trading rests on 3 essential pillars: mind, method, and money. Mind represents the psychological discipline and emotional control required for trading. Method refers to having a sound and tested trading system or strategy. Money signifies prudent risk management and the protection of trading capital. Neglecting any of these 3 pillars significantly reduces the probability of long-term success. Psychological discipline and risk management are often underestimated, but are as crucial as having a good trading method. Elder stresses that a balanced approach, focusing on all 3 pillars, is the foundation for consistent profitability in trading. Chapter 3, You and the Market. In this chapter, Alexander Elder delves into the complex relationship between the individual trader and the market. He He emphasizes that the market is a powerful and impersonal force, driven by the collective psychology of millions of participants. Elder cautions against viewing the market as a personal adversary or trying to impose one's will upon it. Instead, he advocates for understanding the market's language, price, volume, and time, and learning to trade in harmony with its trends. The chapter highlights the importance of self-awareness, recognizing one's own biases and emotional triggers that can lead to impulsive and counterproductive trading decisions. Elder stresses that successful traders learn to adapt to the market's ever-changing conditions and to align their actions with the prevailing forces, rather than fighting against them. Key takeaways. The market is a powerful and impersonal force, driven by the collective psychology of many participants. Traders should avoid viewing the market as a personal enemy or trying to control it. Understanding the market's language, price, volume, and time is crucial for effective trading. Trading in harmony with market trends, rather than against them, increases the probability of success. Self-awareness of one's own biases and emotional triggers is essential for making rational trading decisions. Successful traders learn to adapt to the market's changing conditions. Elder emphasizes the importance of aligning one's actions with the prevailing market forces. Chapter 4, Trading and Personality. In this chapter, Alexander Elder explores the significant influence of a trader's personality on their trading style and success. He posits that different personality types may be naturally inclined towards certain trading approaches and timeframes. For example, impulsive and action-oriented individuals might be drawn to day trading, while more patient and analytical personalities could find swing trading or longer-term investing more suitable. Elder emphasizes the importance of self-knowledge, understanding one's own personality traits, strengths, and weaknesses, and how these might manifest in trading behavior. He cautions against trying to force oneself into a trading style that clashes with their fundamental personality. Instead, he advocates for choosing a trading approach that aligns with one's natural tendencies, while also being mindful of potential pitfalls associated with those traits, such as impulsivity or overanalysis. Key takeaways. A trader's personality significantly influences their trading style and potential success. Different personality types may be naturally suited to different trading approaches and timeframes. Self-knowledge, including understanding one's strengths and weaknesses, is crucial for effective trading. Traders should avoid forcing themselves into a trading style that clashes with their fundamental personality. Choosing a trading approach that aligns with one's natural tendencies can increase comfort and consistency. It is important to be aware of potential pitfalls associated with one's personality traits, such as impulsivity or overanalysis. Elder suggests that aligning trading style with personality, while maintaining awareness of potential biases, can lead to more sustainable and enjoyable trading. Chapter 5, The Forces that Move the Market. In this chapter, Alexander Elder delves into the underlying forces that drive market movements. He identifies two primary categories: fundamental forces and psychological forces. Fundamental forces encompass economic factors such as supply and demand, interest rates, inflation, and political events that influence the perceived value of assets. Psychological forces, on the other hand, stem from the collective emotions and expectations of market participants, including fear, greed, hope, and panic. Elder explains that while fundamental analysis attempts to determine the intrinsic value of an asset, psychological factors often dominate short to medium-term price action. He emphasizes that successful traders need to be aware of both types of forces and understand how they interact to create market trends. Recognizing the interplay between objective fundamentals and subjective crowd psychology is crucial for anticipating potential market moves and making informed trading decisions. Key takeaways. Market movements are driven by two primary forces: fundamental and psychological. Fundamental forces include economic and political factors affecting asset value. Psychological forces arise from the collective emotions and expectations of market participants. While fundamentals indicate value, psychology often dominates short to medium-term price action. Successful traders must be aware of both fundamental and psychological forces. Understanding how these forces interact is crucial for anticipating market trends. Recognizing the interplay between objective fundamentals and subjective crowd psychology is key to informed trading decisions. Chapter 6: The Psychology of Individual Investors. In this chapter, Alexander Elder focuses on the common psychological pitfalls that often plague individual investors and traders. He explores various cognitive biases and emotional tendencies that can lead to irrational decision-making in the market. Examples include the fear of missing out, FOMO, loss aversion, the tendency to feel the pain of losses more acutely than the pleasure of gains, confirmation bias, seeking out information that confirms existing beliefs, and the gambler's fallacy, believing that past random events affect future probabilities. Elder explains how these ingrained psychological patterns can cause individuals to buy high, sell low, hold on to losing positions for too long, and take profits too early. He emphasizes the importance of recognizing these common biases in oneself and actively working to overcome them through self-awareness, discipline, and the development of objective trading rules. Key takeaways: individual investors and traders are prone to various common psychological pitfalls. Cognitive biases like FOMO, loss aversion, and confirmation bias can lead to irrational trading decisions. Emotional tendencies often cause individuals to buy high and sell low. Holding on to losing positions too long and taking profits too early are common psychological mistakes. Recognizing these biases in oneself is the first step towards overcoming them. Self-awareness, discipline, and the development of objective trading rules are crucial for mitigating psychological pitfalls. Elder stresses the need for continuous self-monitoring and conscious effort to avoid these detrimental psychological traps. Chapter 7: The Psychology of Crowds. In this chapter, Alexander Elder examines the powerful influence of crowd psychology on market movements. He explains how individual emotions and biases can become amplified and contagious when people act collectively in the market. Elder discusses phenomena such as herd behavior, where individuals follow the actions of a larger group, often leading to irrational exuberance during rallies and panic selling during declines. He highlights the role of social proof and the fear of missing out in driving these crowd dynamics. The chapter emphasizes that understanding crowd psychology is crucial for traders because it often overrides individual fundamental analysis and can create significant price swings. Elder advises traders to be aware of these collective emotional waves, to avoid getting swept up in the frenzy, and to learn to identify potential turning points where the crowd's sentiment may be reaching extremes. Key takeaways: crowd psychology has a powerful influence on market movements, often amplifying individual emotions and biases. Herd behavior, where individuals follow the actions of the group, can lead to irrational market extremes. Social proof and the fear of missing out are key drivers of crowd dynamics. Understanding crowd psychology is crucial because it can override fundamental analysis and create significant price swings. Traders should be aware of collective emotional waves and avoid getting swept up in the frenzy. Identifying potential turning points where crowd sentiment reaches extremes can offer trading opportunities. Elder advises traders to maintain an independent perspective and to be wary of the emotional extremes of the crowd. Part 2: Trading Tools: Finding Your Way in the Forest. Chapter 8: The Three Pillars of Trading. In this chapter, Alexander Elder revisits and expands upon the three essential pillars he introduced earlier as the foundation of successful trading: mind, method, and money. He emphasizes that these three elements are interconnected and equally crucial. Neglecting any one will significantly hinder a trader's progress. Elder elaborates on the mind aspect, stressing the importance of emotional discipline, self-awareness, and a realistic attitude towards the market. Regarding method, he underscores the need for a sound trading system that identifies entry and exit points based on objective analysis of price, time, and volume. For money, he delves deeper into risk management principles, emphasizing the protection of capital and the use of appropriate position sizing to survive inevitable losing streaks. The chapter serves as a reminder that a balanced and integrated approach to all three pillars is essential for long-term profitability and survival in the challenging world of trading. Key takeaways. Successful trading is built upon three interconnected and equally important pillars: mind, method, and money. Mind encompasses emotional discipline, self-awareness, and a realistic market attitude. Method refers to a sound trading system based on objective analysis of price, time, and volume. Money signifies robust risk management, capital protection, and appropriate position sizing. Neglecting any of these three pillars significantly reduces the chances of long-term success. A balanced and integrated approach to mind, method, and money is crucial for consistent profitability. Elder reinforces that mastery of all three pillars is a continuous process for every trader. Chapter 9: Time. In this chapter, Alexander Elder emphasizes the critical yet often overlooked role of time in trading analysis. He explains that price movements must always be considered within a specific time frame. Elder introduces the concept of trading in multiple time frames, suggesting that successful traders analyze charts on at least three different timescales: a long-term chart to identify the dominant trend, an intermediate-term chart for trade selection, and a short-term chart for precise entry and exit points. He illustrates how analyzing price action across these different time horizons can provide a more comprehensive understanding of market dynamics and help traders align their individual trades with the prevailing long-term trend. The chapter underscores the importance of understanding the relationship between different time frames to avoid trading against the primary trend and to improve the timing of entries and exits. Key takeaways. Time is a crucial dimension in trading analysis and should always be considered alongside price and volume. Successful traders analyze charts in multiple time frames to gain a comprehensive market perspective. A common approach involves using long-term charts for trend identification, intermediate-term charts for trade selection, and short-term charts for entry and exit timing. Analyzing price action across different time horizons helps traders understand market dynamics. Trading in alignment with the dominant long-term trend increases the probability of success. Understanding the relationship between different time frames improves the timing of trade entries and exits. Elder stresses that ignoring the time dimension can lead to flawed analysis and poor trading decisions. Chapter 10: Price. In this chapter, Alexander Elder focuses on the fundamental element of price in trading analysis. He explains that price charts visually represent the history of trading activity and provide crucial information about supply and demand. Elder discusses various ways to analyze price action, including identifying trends, support and resistance levels, and chart patterns. He emphasizes that understanding how price moves and reacts at key levels is essential for making informed trading decisions. The chapter highlights the importance of using price charts in conjunction with other indicators and tools, rather than relying on price action alone. Elder underscores that while price is the ultimate outcome of market forces, interpreting its movements within a broader context of time and volume provides a more robust analytical framework. Key takeaways. Price charts are a fundamental tool in trading, visually representing trading history and supply-demand dynamics. Analyzing price action involves identifying trends, support and resistance levels, and chart patterns. Understanding how price moves and reacts at key levels is essential for informed trading decisions. Price charts should be used in conjunction with other indicators and tools for a more comprehensive analysis. While price is the ultimate market outcome, interpreting its movements within the context of time and volume is crucial. Elder stresses that a thorough understanding of price behavior is a cornerstone of effective technical analysis. Chapter 11: Volume. In this chapter, Alexander Elder emphasizes the significant role of volume in confirming price action and providing insights into the conviction behind market movements. He explains that volume represents the number of shares or contracts traded during a specific period. Elder illustrates how analyzing volume in conjunction with price can help traders differentiate between strong, sustainable moves and weak, potentially false breakouts. He discusses various rules of thumb for interpreting volume, such as volume typically increasing in the direction of a strong trend and decreasing during corrections. The chapter highlights the importance of looking for divergences between price and volume, which can signal potential trend reversals. Elder underscores that volume analysis adds a crucial layer of confirmation to price patterns and can help traders avoid being misled by price action alone. Key takeaways. Volume represents the number of shares or contracts traded and provides insights into the conviction behind price movements. Analyzing volume alongside price helps differentiate between strong, sustainable moves and weak, potentially false breakouts. Volume typically increases in the direction of a strong trend and decreases during corrections. Divergences between price and volume can signal potential trend reversals. Volume analysis adds a crucial layer of confirmation to price patterns. Relying on price action alone without considering volume can lead to being misled. Elder stresses that understanding and incorporating volume analysis into one's trading is essential for more informed trading decisions. Chapter 12, Point and Figure Charts. In this chapter, Alexander Elder introduces point and figure charts as a distinct and valuable tool for analyzing price movements, particularly for identifying significant support and resistance levels and projecting potential price targets. He explains that unlike traditional time-based charts, point and figure charts filter out minor price fluctuations and focus solely on significant price changes. Elder details the construction of these charts using X columns to represent rising prices and O columns to represent falling prices, with reversals occurring only after a specified box size and reversal criteria are met. He illustrates how point and figure charts can help traders identify clear breakout levels, project potential upside and downside targets based on chart patterns, and avoid the noise associated with time-based fluctuations. The chapter emphasizes that while point and figure charts don't incorporate volume or time directly, they offer a unique and uncluttered perspective on pure price action and can be a valuable addition to a trader's toolkit. Key takeaways. Point and figure charts are a unique tool for analyzing price movements by filtering out minor fluctuations. They focus solely on significant price changes, using X for rising and O for falling prices. Reversals occur only after a specified box size and reversal criteria are met. Point and figure charts help identify significant support and resistance levels clearly. They can be used to project potential upside and downside price targets based on chart patterns. These charts help traders avoid the noise associated with time-based fluctuations. While they don't directly incorporate volume or time, they offer a valuable perspective on pure price action. Elder suggests that point and figure charts can be a useful addition to a trader's analytical toolkit. Chapter 13, Computerized Data Services. In this chapter, Alexander Elder discusses the crucial role of computerized data services in modern trading. He emphasizes that reliable and comprehensive data is essential for effective technical analysis and informed decision-making. Elder outlines the various types of data services available to traders, including those providing real-time quotes, historical price and volume data, news feeds, and charting capabilities. He highlights the importance of choosing a reputable and robust data provider that offers the specific information and tools a trader needs for their chosen markets and trading style. The chapter also touches upon the significance of data accuracy and the potential pitfalls of relying on incomplete or erroneous information. Elder underscores that investing in quality data services is a necessary expense for serious traders, as it forms the foundation for sound analysis and the effective application of trading tools and systems. Key takeaways. Reliable and comprehensive computerized data services are essential for modern trading. These services provide real-time quotes, historical data, news, and charting capabilities. Choosing a reputable and robust data provider that meets specific needs is crucial. Data accuracy is paramount. Relying on incomplete or erroneous information can be detrimental. Investing in quality data services is a necessary expense for serious traders. Good data forms the foundation for sound technical analysis and informed decision-making. Elder advises traders to carefully evaluate and select a data service that aligns with their trading requirements. Chapter 14, Trading Systems. In this chapter, Alexander Elder delves into the concept of trading systems and their importance for disciplined and objective trading. He defines a trading system as a set of objective rules that specify the conditions for entering, exiting, and managing trades. Elder emphasizes that a well-defined trading system removes emotional decision-making and provides a consistent framework for interacting with the market. He discusses the key components of a trading system, including market selection, position sizing, entry rules, stop-loss orders, and profit targets. The chapter highlights the benefits of using a systematic approach, such as reducing impulsivity, promoting consistency, and allowing for the objective evaluation of trading performance through back-testing and forward testing. Elder stresses that while finding the perfect system is often a futile pursuit, developing and diligently following a robust system that aligns with one's trading style and risk tolerance is crucial for long-term success. Key takeaways. A trading system is a set of objective rules for entering, exiting, and managing trades. A well-defined system removes emotional decision-making and provides a consistent trading framework. Key components of a trading system include market selection, position sizing, entry rules, stop-loss orders, and profit targets. Using a systematic approach reduces impulsivity and promotes consistency in trading. Trading systems allow for objective evaluation of performance through testing. Finding the perfect system is unlikely, but developing and following a robust system is crucial. The chosen system should align with the trader's style and risk tolerance. Elder emphasizes that adherence to a well-defined trading system is a cornerstone of disciplined and profitable trading. Chapter 15, The Impulse System. In this chapter, Alexander Elder introduces his own impulse system, a trading system designed to identify potential entry and exit points by combining trend following and momentum indicators. The system uses two indicators, a 13-day exponential moving average, EMA, to identify the prevailing trend, and the moving average convergence divergence, MACD, histogram, to gauge momentum. Elder explains that buy signals are generated when both the EMA indicates an upward trend, current price above the EMA, and the MACD histogram is rising, indicating increasing bullish momentum. Conversely, sell signals occur when the price is below the EMA, downward trend, and the MACD histogram is falling, increasing bearish momentum. The chapter details how to interpret the signals generated by the impulse system and emphasizes its use on multiple time frames to align trades with the dominant trend. Elder also discusses how to use the impulse system in conjunction with stop-loss orders and profit targets to manage risk effectively. Key takeaways. The impulse system combines trend following and momentum MACD histogram indicators. A 13-day EMA identifies the prevailing trend, price above for uptrend, below for downtrend. The MACD histogram gauges momentum, rising for bullish, falling for bearish. Buy signals occur when the price is above the EMA and the MACD histogram is rising. Sell signals occur when the price is below the EMA and the MACD histogram is falling. The impulse system should be used on multiple time frames to align trades with the dominant trend. Stop-loss orders and profit targets are essential for managing risk when using the system. Elder presents the impulse system as a practical tool for identifying potential trading opportunities based on trend and momentum. Chapter 16, Trading with the Elder Ray. In this chapter, Alexander Elder introduces another of his own trading tools, the Elder Ray, which is designed to gauge the balance of power between buyers, bulls, and sellers, bears in the market. The Elder Ray consists of three components: the exponential moving average, EMA, to identify the prevailing trend, the bull power indicator to measure the strength of the buyers, and the bear power indicator to measure the strength of the sellers. Elder explains that bull power is calculated as the high minus the EMA, indicating how far bulls were able to push prices above the average. Bear power is calculated as the low minus the EMA, showing how far bears were able to push prices below the average. The chapter details how to interpret the readings of each component and how to use the Elder Ray in conjunction with the trend identified by the EMA to find potential trading opportunities. Elder emphasizes looking for divergences between the Elder Ray indicators and price as potential signals of trend changes, and provides guidelines for using the Elder Ray for both entries and exits. Key takeaways. The Elder Ray gauges the balance of power between buyers, bulls, and sellers, bears. It consists of a trend indicator, EMA, bull power, high minus EMA, and bear power, low minus EMA. Bull power measures the strength of buyers. Bear power measures the strength of sellers. The Elder Ray is used in conjunction with the EMA to trade in the direction of the trend. Divergences between the Elder Ray indicators and price can signal potential trend changes. The chapter provides guidelines for using the Elder Ray for identifying both entry and exit points. Elder presents the Elder Ray as a valuable tool for understanding the underlying forces driving price movements. Chapter 17, Safe Zone Stops. In this chapter, Alexander Elder introduces his concept of safe zone stops, a method for placing stop-loss orders that aims to protect trading capital while allowing trades sufficient room to fluctuate within normal market volatility. He critiques the common practice of placing stops too tightly, which can lead to being prematurely stopped out of potentially profitable trades due to minor price swings. Elder advocates for placing stops at a safe distance, away from the entry price, based on the market's average true range, ATR, or visually significant support and resistance levels. He explains that using the ATR helps to account for the inherent volatility of the instrument being traded, while placing stops below key support in an uptrend or above key resistance in a downtrend provides a logical level where the initial trading idea would likely be invalidated. The chapter emphasizes that while safe zone stops may result in slightly larger potential losses compared to very tight stops, they increase the probability of a trade playing out as intended by giving it adequate breathing room. Key takeaways. Safe zone stops aim to protect capital while allowing trades room to fluctuate within normal volatility. Placing stops too tightly can lead to being prematurely stopped out. Safe zone stops are placed at a safe distance based on ATR or significant support resistance levels. Using ATR accounts for the inherent volatility of the traded instrument. Placing stops beyond key support in uptrends or resistance in downtrends provides a logical invalidation point. Safe zone stops may result in slightly larger potential losses, but increase the probability of a trade working out. Elder advocates for using safe zone stops as a more effective way to manage risk than arbitrarily tight stops. Part 3, Risk Management, How to Stay in the Game. Chapter 18, Risk, the Enemy Within. In this chapter, Alexander Elder emphasizes that while the market presents external risks, the most significant threats to a trader's longevity often come from within, from the mismanagement of risk. He argues that psychological factors, such as the fear of missing out, the desire to recoup losses quickly, and overconfidence after wins, can lead traders to take on excessive risk. Elder highlights that uncontrolled risk exposure is the primary reason why most traders fail. He stresses the importance of recognizing one's own psychological vulnerabilities and proactively establishing strict risk management rules to protect trading capital. The chapter serves as a stark reminder that survival in the market is paramount, and that consistently controlling risk is far more important than trying to hit big winners. Elder lays the groundwork for the subsequent chapters on specific risk management techniques by establishing the fundamental principle that risk, if not diligently managed, will inevitably lead to ruin. Key takeaways. The most significant threats to a trader often come from the mismanagement of risk, driven by internal psychological factors. Fear of missing out, the desire for quick recovery, and overconfidence can lead to excessive risk-taking. Uncontrolled risk exposure is the primary cause of failure for most traders. Recognizing one's own psychological vulnerabilities is crucial for effective risk management. Establishing and strictly adhering to risk management rules is essential for protecting trading capital. Survival in the market is paramount and depends on consistently controlling risk. Elder emphasizes that managing risk effectively is more important than focusing solely on maximizing profits. Chapter 19, the 2% Rule. In this chapter, Alexander Elder introduces his cornerstone risk management principle, the 2% Rule. This rule dictates that a trader should never risk more than 2% of their trading capital on any single trade. Elder meticulously explains the rationale behind this rule, emphasizing that it is designed to protect a trader from catastrophic losses during inevitable losing streaks. He illustrates how even a series of consecutive losing trades will not decimate an account if the 2% rule is consistently applied. The chapter provides clear examples of how to calculate the appropriate position size based on the 2% rule, taking into account the account equity and the distance of the stop-loss order from the entry price. Elder underscores that adhering to the 2% rule is a fundamental practice for long-term survival and consistent growth in the highly uncertain environment of the market. Key takeaways. The 2% rule is a cornerstone of effective risk management. It states that a trader should never risk more than 2% of their trading capital on a single trade. This rule protects against catastrophic losses during losing streaks. Applying the 2% rule consistently ensures that a series of losses will not decimate the trading account. The chapter provides clear instructions on how to calculate appropriate position size based on the 2% rule. Account equity and the stop-loss distance are key factors in position size calculation. Elder emphasizes that adhering to the 2% rule is fundamental for long-term survival and consistent growth. Chapter 20, the 6% Rule. In this chapter, Alexander Elder introduces a supplementary risk management guideline to his 2% rule, the 6% Rule. This rule states that a trader should never risk more than 6% of their total trading capital in any single month. Elder explains that while the 2% rule limits the risk on any individual trade, the 6% rule acts as a broader control mechanism to prevent excessive cumulative losses over a shorter period. He emphasizes that even with diligent application of the 2% rule, a series of uncorrelated losing trades could still lead to significant drawdowns if not managed at a monthly level. The 6% rule serves as a circuit breaker, forcing a trader to reassess their strategies and risk management if they experience substantial losses within a month. Elder underscores that this rule is crucial for preventing emotional responses to losing streaks from further jeopardizing trading capital and for promoting a more measured and sustainable approach to the market. Key takeaways. The 6% rule is a supplementary risk management guideline to the 2% rule. It states that a trader should never risk more than 6% of their total capital in any single month. This rule prevents excessive cumulative losses over a shorter period, even with adherence to the 2% rule. The 6% rule acts as a circuit breaker, prompting reassessment after significant monthly losses. It helps prevent emotional responses to losing streaks from further damaging capital. The rule promotes a more measured and sustainable approach to trading. Elder emphasizes that the 6% rule provides an additional layer of protection for trading capital. Chapter 21, Managing an Open Position. In this chapter, Alexander Elder shifts focus from pre-trade risk management to the crucial aspects of managing a trade once it is live. He emphasizes that the initial entry is only one part of a successful trade. How a position is managed after entry significantly impacts the final outcome. Elder discusses various techniques for managing open positions, including adjusting stop-loss orders to lock in profits or reduce risk as the trade moves in the desired direction. He introduces the concept of using trailing stops and explains how to determine appropriate levels for adjusting stops based on market volatility and chart patterns. The chapter also touches upon the importance of having a predefined profit target, but being flexible enough to let winners run if market conditions warrant. Elder underscores that proactive and thoughtful management of open positions is essential for maximizing profits and minimizing losses, turning potentially good entries into truly successful trades. Key takeaways. Managing an open position is as crucial as the initial entry for a successful trade. Techniques for managing open positions include adjusting stop-loss orders to lock in profits or reduce risk. Trailing stops can be used to protect gains as a trade moves favorably. Stop-loss levels can be adjusted based on market volatility and chart patterns. Having a profit target is important, but flexibility to let winners run in favorable conditions is also key. Proactive and thoughtful management of open positions maximizes profits and minimizes losses. Elder emphasizes that effective position management can transform good entries into truly profitable trades. Chapter 22, Pyramiding: How to Ride a Winner. In this chapter, Alexander Elder explores the technique of pyramiding, which involves adding to a winning trade as it moves in the desired direction. He emphasizes that pyramiding should only be done on profitable trades, never on losing ones, as adding to losers compounds risk. Elder outlines specific rules for pyramiding, such as adding new positions at logical support levels in an uptrend or resistance levels in a downtrend, and only adding with a smaller position size than the initial trade. He stresses the importance of moving the stop-loss order for the entire position higher in an uptrend or lower in a downtrend as new layers are added to protect profits. The chapter highlights that pyramiding can significantly enhance the profitability of winning trades by capitalizing on strong trends, but it requires discipline and careful risk management to avoid over-leveraging and turning a winner into a loser. Key takeaways. Pyramiding involves adding to a winning trade as it moves favorably. It should only be done on profitable trades, never on losing ones. New positions should be added at logical support in uptrends or resistance in downtrends. Subsequent additions should typically be smaller than the initial position. The stop-loss order for the entire pyramided position should be moved to protect profits as layers are added. Pyramiding can significantly enhance the profitability of winning trades in strong trends. It requires discipline and careful risk management to avoid over-leveraging. Elder presents pyramiding as a powerful technique for maximizing gains from winning trades when implemented correctly. Chapter 23, Trading for Total Returns. In this chapter, Alexander Elder broadens the perspective beyond just individual trade profits to focus on the concept of total returns, which encompasses not only capital appreciation from trading, but also income generated from dividends or interest. He argues that a holistic approach to investing and trading should consider all potential sources of return. Elder discusses strategies that combine active trading with longer-term investments in dividend-paying stocks or other income-generating assets. He emphasizes the benefits of this approach, such as providing a more stable and consistent stream of returns, reducing overall portfolio volatility, and allowing traders to potentially compound their wealth more effectively over time. The chapter highlights the importance of aligning one's trading and investment strategies with their long-term financial goals and risk tolerance to achieve sustainable total returns. Key takeaways. Total returns encompass both capital appreciation from trading and income from dividends or interest. A holistic approach to investing and trading should consider all potential sources of return. Combining active trading with longer-term investments in income-generating assets can be beneficial. This approach can provide a more stable and consistent stream of returns. It can also help reduce overall portfolio volatility. Integrating trading and investment strategies can lead to more effective wealth compounding over time. Aligning strategies with long-term financial goals and risk tolerance is crucial for sustainable total returns. Elder encourages traders to consider a broader perspective beyond just short-term trading profits. Part 4, Trade Management, the 3 M's. Chapter 24, Mind, the Disciplined Trader. In this chapter, Alexander Elder revisits the crucial element of mind in his 3 M's framework, emphasizing the paramount importance of psychological discipline for consistent trading success. He argues that even with a profitable trading method and sound risk management, a lack of mental control can sabotage a trader's efforts. Elder delves into the emotional challenges that traders face, such as fear, greed, hope, and regret, and how these emotions can lead to impulsive and irrational decisions. He provides practical strategies for cultivating discipline, including setting clear trading rules and adhering to them rigorously, developing a trading plan and following it meticulously, and practicing self-awareness to recognize and manage emotional triggers. The chapter underscores that mastering one's own mind is an ongoing process, and that the disciplined trader is one who consistently acts in accordance with their well-defined strategy, regardless of short-term emotional fluctuations or market pressures. Key takeaways. Psychological discipline is paramount for consistent trading success, even with a good method and risk management. Emotions like fear, greed, hope, and regret can lead to irrational trading decisions. Cultivating discipline involves setting clear trading rules and adhering to them rigorously. Developing and meticulously following a trading plan is essential for mental control. Practicing self-awareness helps recognize and manage emotional triggers. Mastering one's mind is an ongoing process for every trader. The disciplined trader consistently acts according to their strategy, despite emotions or market pressures. Elder emphasizes that mental fortitude is a key differentiator between successful and unsuccessful traders. Chapter 25, Method, Working with a System. In this chapter, Alexander Elder elaborates on the second M of his framework, method, which refers to having a well-defined and tested trading system. He reiterates that a robust system provides objective rules for identifying trading opportunities, determining entry and exit points, and managing trades. Elder discusses the key characteristics of a good trading system, including clarity, simplicity, and objectivity. He emphasizes the importance of understanding the rationale behind the chosen system and ensuring that it aligns with one's trading style and personality. The chapter also touches upon the process of developing or selecting a trading system, as well as the critical steps of backtesting and forward testing to evaluate its historical performance and potential viability in live trading. Elder underscores that consistently applying a well-understood and tested trading system removes ambiguity and emotional bias from the decision-making process, leading to more consistent results. Key takeaways. Method refers to having a well-defined and tested trading system with objective rules. A robust trading system provides clear entry and exit points and guidelines for trade management. Key characteristics of a good system include clarity, simplicity, and objectivity. Understanding the rationale behind the chosen system and its alignment with one's style is important. Developing or selecting a system should be followed by thorough backtesting and forward testing. Consistently applying a well-understood and tested system removes ambiguity and emotional bias. Elder emphasizes that a sound trading method is a crucial component of long-term trading success. Chapter 26, Money Risk Management. In this chapter, Alexander Elder revisits the third M of his framework, money, which he equates with prudent risk management. He reiterates that protecting trading capital is paramount for long-term survival and success in the market. Elder reviews the key risk management principles discussed earlier, including the 2% rule, risking no more than 2% of capital per trade, and the 6% rule, risking no more than 6% of capital in a month. He emphasizes the importance of consistently applying these rules to avoid catastrophic losses and to manage drawdowns effectively. The chapter also touches upon the concept of position sizing, ensuring that trade sizes are appropriate for the account size and the risk being taken. Elder underscores that effective risk management is not just about limiting losses. It's about enabling a trader to stay in the game long enough to capitalize on their winning trades and achieve consistent profitability over time. Key takeaways. Money in Elder's framework equates to prudent and consistent risk management. Protecting trading capital is paramount for long-term survival and success. The 2% rule, maximum risk per trade, and the 6% rule, maximum monthly risk, are crucial guidelines. Consistent application of these rules helps avoid catastrophic losses and manage drawdowns. Appropriate position sizing, relative to account size and risk, is essential. Effective risk management enables traders to stay in the game long enough to profit. Elder emphasizes that managing risk is fundamental to achieving consistent profitability over time. Chapter 27, The Daily Routine of a Successful Trader. In this chapter, Alexander Elder outlines the typical daily activities and mindset of a successful trader. He emphasizes the importance of structure, planning, and consistent execution. Elder suggests starting the day by reviewing the overall market context, using longer-term charts to understand the prevailing trends. He then recommends analyzing potential trading opportunities on intermediate-term charts, identifying setups that align with the trader's system. Before the trading day begins, a successful trader will have a clear plan for each potential trade, including entry points, stop-loss levels, and profit targets. During the trading day, the focus is on disciplined execution of the plan, avoiding impulsive decisions based on emotions. Elder also highlights the importance of keeping a trading journal to track trades, analyze performance, and learn from both successes and failures. After the trading day, reviewing trades and planning for the next day are crucial for continuous improvement. The chapter underscores that successful trading is not a chaotic endeavor, but rather a structured and disciplined routine. Successful traders follow a structured daily routine that emphasizes planning and consistent execution. The day typically begins with reviewing longer-term charts to understand market trends. Analyzing intermediate-term charts helps identify potential trading opportunities. A clear trading plan, including entry, stop-loss, and profit targets, is prepared before trading. Disciplined execution of the plan during the trading day is paramount, avoiding emotional decisions. Keeping a detailed trading journal is essential for tracking performance and learning. Reviewing trades and planning for the next day are crucial for continuous improvement. Elder emphasizes that successful trading is a structured and disciplined routine, not a chaotic activity. Chapter 28, The Well-Organized Trader. In this chapter, Alexander Elder stresses the importance of organization in achieving and maintaining trading success. He argues that a well-organized trading environment and workflow contribute significantly to clarity of thought, reduced stress, and improved decision-making. Elder discusses various aspects of organization, including maintaining a clean and functional trading workspace, keeping meticulous records of trades and trading plans, and having a systematic approach to market research and analysis. He emphasizes the value of creating and adhering to checklists to ensure that all necessary steps are followed before entering a trade. The chapter also touches upon the importance of managing one's time effectively and avoiding distractions during trading hours. Elder underscores that a well-organized trader is better equipped to execute their strategies consistently and to learn from their experiences, ultimately leading to more sustainable profitability. Key takeaways. Organization is crucial for clarity, reduced stress, and improved decision-making in trading. Maintaining a clean and functional trading workspace is beneficial. Meticulous record-keeping of trades and plans is essential for analysis and learning. A systematic approach to market research and analysis improves efficiency. Using checklists helps ensure all necessary steps are followed before trading. Effective time management and avoiding distractions during trading hours are important. A well-organized trader can execute strategies consistently and learn more effectively. Elder emphasizes that organization is a key component of long-term trading success. Chapter 29, Trading as a Business. In this chapter, Alexander Elder advocates for treating trading not as a hobby or a gamble, but as a serious business endeavor. He emphasizes that adopting a business mindset is crucial for achieving consistent profitability and longevity in the market. Elder outlines several key aspects of approaching trading as a business, including developing a detailed business plan with clear goals and strategies, managing capital as business inventory, accounting for all expenses such as data fees and education, and reinvesting profits wisely for growth. He stresses the importance of continuous learning and professional development, just as in any other business. The chapter also touches upon the need for discipline, perseverance, and a long-term perspective, recognizing that building a successful trading business takes time and effort. Elder underscores that by adopting a professional and business-like approach, traders can increase their chances of success and treat their trading activities with the seriousness they deserve. Key takeaways: treating trading as a serious business is crucial for consistent profitability and longevity. A business plan with clear goals and strategies should be developed. Trading capital should be managed as business inventory. All trading-related expenses should be accounted for. Profits should be reinvested wisely for business growth. Continuous learning and professional development are essential. Discipline, perseverance, and a long-term perspective are necessary. Elder emphasizes that a professional and business-like approach increases the chances of trading success. Chapter 30, The Road to Mastery. In this concluding chapter, Alexander Elder reflects on the ongoing journey of becoming a successful trader and emphasizes that mastery is not a destination, but a continuous process of learning, adaptation, and self-improvement. He reiterates the importance of the 3 M's, mind, method, and money, as the foundational pillars of trading success, stressing that consistent effort and development in all 3 areas are essential. Elder highlights the need for patience and perseverance, acknowledging that achieving mastery in trading takes time, dedication, and the willingness to learn from both successes and failures. He encourages traders to remain humble, to continuously seek knowledge, and to adapt their strategies as market conditions evolve. The chapter concludes with an inspiring message, emphasizing that while the road to mastery may be challenging, the rewards of financial freedom and personal growth are well worth the effort for those who remain committed to the journey. Key takeaways: mastery in trading is a continuous process of learning, adaptation, and self-improvement, not a final destination. Consistent effort and development in mind, method, and money are essential for progress. Patience and perseverance are crucial, as mastery takes time and dedication. Learning from both successes and failures is an integral part of the journey. Remaining humble and continuously seeking knowledge are important for growth. Adapting strategies to evolving market conditions is necessary for long-term success. Elder concludes with an encouraging message about the rewards of financial freedom and personal growth for committed traders. And that brings us to the close of another powerful chapter breakdown from Alexander Elder's The New Trading for a Living. We hope you've gained some valuable insights into the crucial elements of mind, method, and money. If you found this deep dive into Elder's wisdom helpful, please give this video a thumbs up. Share it with your fellow traders who are on the path to mastery. We'd love to hear your key takeaways in the comments below. What resonated with you the most? To continue your journey of becoming a well-rounded and successful trader, make sure you hit that subscribe button and ring the notification bell. We've got more PowerBooks insights coming your way that can truly make a difference in your trading results. If you're serious about implementing Alexander Elder's comprehensive approach to trading psychology, system development, and risk management, we highly recommend picking up the full version of The New Trading for a Living. You'll find a link to purchase it in the description below. It's a book that belongs on every serious trader's shelf. Remember, the road to trading mastery is a marathon, not a sprint. Focus on continuous learning, disciplined execution, and consistent self-improvement. You've got this, PowerBooks fam. We'll see you in the next video.